Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to your Tax-Free Life podcast. As always, I'm excited to be here, as we are every single week, trying to provide information and education to all of you, so all of you can have a much better financial life, not only now, but also in the future. This is actually episode 79. And as I stated last week, this is a part 7 series. So today we're actually doing part 2 of understanding your financial paradigms. And if you recall last week when we did part 1, we talked a little bit about the different the different ways that people used to look at retirement compared to the way that they need to look at retirement today. And we addressed the paradigm shift that needs to take place. And the sooner that it takes place, the better it's going to be for all of us that are listening to this podcast on a weekly basis. And again, I ask you all to subscribe to our channel, so that way you can get an automatic download every single week as we cover topics of importance for many of you. And the second part that we're going to covering today, regarding the understanding of your financial paradigms, obviously we're going to be discussing taxation. And we're going to be touching upon a few things that I think are very critical as you start to thinking about your retirement distribution planning. Number one, why tax rates could actually double in the very near future. Number two, how our nation's debt may actually force taxes to rise over time, especially after the sunsetting of the Tax Cuts and Jobs Act, which will be sunsetting December 31st, 2025. Number three, the extent to which our entitlement programs are underfunded. So it's important to understand what is happening in our country with all the entitlement programs that some of us have been enjoying for years, although other people may be pretty close to start to enjoy them, and then many of you are years away from enjoying these programs. But obviously the impact of the underfunding of these programs may generate major challenges, not only for this country, but also for each and every American that lives in the United States. Number four would be how rising taxes may affect your cash flow in retirement and the impact that that's going to have on your financial life. And then last but not least, how the deductions that you may lose in your retirement years may actually affect your tax burden in retirement. So I think one of the questions that I get often asked, and last Saturday we did a seminar at Florida International University, which is an educational seminar that I conduct on a monthly basis, and we have another one this coming Saturday. And one of the questions that we get asked all the time is, why do we think, or why do Americans think that taxes may actually double in the future? And we also have to then take a look at the old paradigm shift, or the old ways of looking at things versus a new paradigm. In the old paradigm, people would tell you that you would be in a lower tax bracket in retirement. They will also tell you that you're going to live on less income than you did while you were working. They will also address the fact that, according to them, that tax-deferred investments were the best way to build wealth in the United States. While the new paradigm has actually changed all of those things that I have just mentioned. Number one, you may very well be in a higher tax bracket in retirement than you are today. And I'll explain the reason why in the next few minutes. Number two, you may need as much income in retirement as you did prior to retirement, especially when you start to factor in, taxes, inflation, lost opportunity cost, stock market volatility, interest rate volatility, and so forth. Number 3, tax-deferred investments should be made only under certain circumstances, and I'll cover a little bit about that in the next few minutes as well. And number 4, you may actually lose viable deductions in retirement that you enjoyed while you were employed. So these are things that are very, very critical, and that can, in many different ways, get to the point where taxes may have to double in the United States, and may actually double for you, because at the end of the day, your personal income tax rate is a critical one, and you have to be able to manage those accordingly. What would be some of the deductions that you may actually lose, and they may go away in retirement? Well, your mortgage deduction, if your mortgage is paid for, or if you're in year 25 of a 30-year mortgage, the vast majority of the mortgage payments that you're making at that point in time is primarily going toward principal, and very little is going toward the interest on that debt. So therefore, the deductible numbers are going to be lower. Your children are a double whammy, as I call them, because they're a deduction and they're also a credit. So as they get older, even if you're in retirement and they live with you, which may be something you don't want to have to deal with, but even if they did, you couldn't take a deduction for them anyways. So they may be a liability, but they're not providing any benefits on the other side of the ledger to you. Also charity. While you're employed, if you're a charitable person, most Americans are making contributions to charity. One of the things that I do notice by doing tax planning, and obviously we do own an accounting firm, is that as people go into retirement, as Americans go into retirement, they start shifting charitable contributions in dollars to charitable contributions in time. So therefore, you may be spending a little bit more of your time working at your favorite charity, but the IRS does not allow you to deduct your time. So you may be making less contributions from a dollar perspective, but you're providing more of your time to that same organization. But obviously those deductions may very well go away. So again, these are things that you need to pay attention to, that we all need to pay attention to as Americans, and we need to understand that if we don't pay attention to what may be happening in the next several years, then chances are we are going to become victims of change, as opposed to trying to target and maximize any change that may be occurring in the future for our own benefit. So again, those are the things that are very critical to understand. The other issue that we've talked about in this podcast many a times is that the Tax Cuts and Jobs Act that was put into place in December of 2017 by the Trump administration to take effect as of January 1 of 2018 will sunset December 31st, 2025. So the first time in history, when you wake up on January 1 of 2026, you will know that taxes will be higher as of January 1 of 2026 than they were as of December 31st of 2025. So we do have right now, if you missed the 2018 window of opportunity, we only have a 7-year window in which to truly attempt to do a really good job from a tax planning perspective. So that way the majority of the investments would be located in the tax-free bucket, as opposed to the taxable bucket in the tax-deferred bucket. The other thing that we need to consider is point number 2 is how our nation's debt may force taxes to rise in the near future. And one of the things that I communicate to all attendees at my seminars on a monthly basis is that those who forget the past are bound to repeat it. And this is something that has happened to all of us, not only as a country, but has happened to many of us as individuals. How many mistakes have you done in the past that you continue to do today? The old definition of insanity of, doing the same thing over and over again while expecting a different result is something that happens quite often unless you pay attention to what is truly happening in your personal economy from a business perspective. So again, those who forget the past are bound to repeat it. Let me give you a couple of examples. Back in 1944 and 1945, the last 2 years of the Second World War, the highest tax bracket was sitting at 94%. Now, those for the 94% tax bracket were for those income earners that were earning at least $200,000 of income. Obviously, there weren't that many people in the United States that were doing that, but that doesn't mean that those taxes are not going to be higher. As a matter of fact, for middle income Americans back in the 40s and 50s, taxes were substantially higher than they are today. If we take a look at tax brackets in the 60s, they were anywhere between 70% and 90% for the highest tax bracket or the highest taxpayers. Even during the 70s, which is not too far back, during the 70s, the highest marginal tax bracket was also 70%. Now, one of the things that we need to be aware of is that we're actually living, and this is contrary to popular beliefs. So, whenever I do a seminar, whenever I engage a client for the first time, one of the questions that I asked is, where do you think taxes are today? And everyone says the same thing. Oh my gosh, Bert, taxes are fairly high today. Actually, we're living in the third lowest historical tax rate in our country's history. Other than the very beginning of the tax code back in 1913 and the beginning of the IRS, in which taxes were never going to go higher than 7.5%. Obviously, we have experienced a totally different answer to that issue that was given to Americans by Congress back in 2013. Other than the 2013 period, and then the second period during the Great Depression between 1929 and 1939, we're actually living again in the third lowest historical tax rate in our country. So when you take a look at the entitlement programs and the debt that we have in our country, we're at the highest possible debt that we have ever seen historically, and we're at the third lowest tax bracket in history. Then we can all use some common sense and determine that there's a very high probability that taxes are going to have to double in the country in the near future, or our country's going to go bankrupt. And this is not only me. This is the experts, the economists. This is the Government Accountability Office and the reporting by the CBO, which is the Congressional Budget Office, that continues to provide this type of information on an annual basis. But Congress has the ability to do absolutely nothing with a tremendous amount of time on their side. So there's a high probability that Congress is not going to do anything about this, because anyone that wants to go after taxes and entitlement programs in the United States can pretty much kiss their political career goodbye. The other issue that is very critical, number 3, is the extent to which our entitlement programs are underfunded. So when you take a look at the major entitlement programs that we have in the United States today, Social Security, Medicare, Medicaid, the interest on the national debt, which is now over $22 trillion as of 2019, Fannie Mae and Freddie Mac, which are, although they're so-called private corporations, they're being fully funded by the federal government. DOD, the Department of Defense, prescription drug program, and pension obligations. Those entitlement programs can actually have a major impact in what's going to happen in our country in the next few years. Think of it this way: by the year 2020, 92 cents out of every dollar that is collected by the U.S. government through taxes will go towards Social Security, Medicare, Medicaid, and interest on the national debt. So those four major programs are gonna require 92 cents of every single dollar that we collect in this country. And by the way, in 2019, for the first year, we're going to be at a deficit of $1 trillion when it comes to the amount of money that our government collects versus the amount of government that our country and our government spends on an annual basis. You know, Ronald Reagan, which was the 40th president of the United States, said many years ago that the problem with our tax system was not that Americans paid too little. The problem with our tax system was that our government spent too much. And that was true then, and it is true today from a business and economic perspective as well. So we have to really understand what's going to happen with our debt. By the way, the additional 8 cents, because 92 cents out of every dollar is going to go to fund the liabilities of those four programs, the additional 8 cents are going to have to cover children's nutrition, border security, food and safety, disaster relief, public housing programs, the IRS, federal courts, NASA, the Bureau of Indian Affairs, the Army, the Air Force, the Coast Guard, research and development, environmental protection agencies, FEMA, the Center for Defense for Disease Control and Prevention, Immigration and Custom Enforcement, and many other programs that are now going to be underfunded because there's not enough money to go around. Now, obviously, if you start looking at the political world today, you start to see how many political pundits are promising everything free in this country. Free education, free Medicare or Medicare for all, free this and free that. But from an economic perspective, no one truly knows how expensive free can be. So the best job that you can do over the next 7 years in order to maximize the tax rates today and to start shifting more and more of your assets from the taxable in the tax-deferred buckets to the tax-free bucket, then the better positioning you and your family are going to be in retirement. Now, the other issue that is very critical, point number 4, is how rising taxes may affect your cash flow in retirement. And this is one of the major areas that my firm and I deal with as we do tax planning and retirement distribution planning for our clients on an ongoing basis. And obviously, if you use common sense, it'll tell you that the higher the tax, the lower the net after-tax income. And thus, Americans may be forced to deplete their retirement assets at a faster pace in order to offset taxation. So think of it this way. If the vast majority of your assets in retirement happen to be sitting in the tax-free bucket, then you're going to have a lot of leverage on your side of the ledger. You're not going to have to take a tremendous amount of risk in the assets that you have in retirement in order to grow them, because you're going to be offsetting that risk by the fact that the vast majority of your retirement income is going to be tax-free, and that's going to be a major benefit to you and your family from a financial standpoint. So how it is, so you're going to do that? Well, there are many ways. There are many ways in which you can start moving your assets from the taxable bucket and the tax-deferred bucket, and they need to be at a certain level, as we have talked in the past, to the tax-free bucket. So at the end of the day, when you reach the summit of retirement, the vast majority of your retirement assets should be located in the tax-free bucket, with a certain percentage in the tax-deferred bucket in order to maximize your retirement income, and a smaller percentage in the taxable bucket in order to avoid taxation. Always remember that when you put money into the tax-deferred bucket, which is your 401ks, your IRAs, your pensions, and so forth, most people think that they're saving money on taxes, and the answer is absolutely not. You are not saving any money on taxes. The only thing that you're doing is you're deferring the tax. And when you defer the tax, you're also deferring the tax liability. So if taxes are going to double in the future, or even if they go up by 25, 30, 35, 40%, or even if your personal tax liabilities increase because of the fact that you no longer have those deductions that you enjoyed while you were working, then you may actually be paying taxes on those dollars that you deferred at a much higher tax rate than you were prior to retirement from that perspective. The other issue to consider is, and this is point number 5, how loss deductions may actually affect your tax burden in retirement. And I touched upon that a few minutes ago, but just so you'll know, most deductions will go away in retirement. And the provisional income calculations thresholds do not increase with inflation. So when you do retire and you start taking Social Security benefits, you're going to have to do, or your accountant or your CPA is going to have to do provisional income calculations, which is something that we do every year for our clients. And we actually do tax forward planning, which is something that the vast majority of accountants cannot do because of the fact that most accountants are looking at their finances, or when they look at taxes for their clients, they're looking in the rearview mirror. They're looking what happened in the previous year in order for them to do the taxes for those clients, not only on a personal basis but also on a business basis for the 2018 year, but they did that in 2019. What we do at Gables Tax Planning Group, which is our tax firm, is not only do the tax preparation, the bookkeeping, and the payroll services for our clients, looking in the rearview mirror, but we also do tax forward planning in order to give us the opportunity to maximize all tax benefits, not only for the current year that we haven't filed taxes on, but also for the next 2 to 3 years down the line. So, and by doing so, we're doing these provisional income calculations as you move forward, because we know that those provisional income calculations, their threshold do not increase by inflation. So the more money you have to report on an annual basis, that may actually create a higher tax liability on your Social Security benefits. Actually, if you don't do it the right way, up to 85% of your Social Security benefits may be taxable in the future, and they're based on whatever tax bracket you may find yourself in at that point in time. The other issue with not understanding provisional income calculations and how to minimize those liabilities is that if you don't do it the right way, not only will your Social Security benefits will be taxed at a higher rate or a higher percentage of them, but also you may end up paying a higher Medicare premium because you may very well go over the threshold. So those are things that are very, very critical to understand. Now, by the way, if Social Security, Medicare, and Medicaid go unchanged, the rate for the lowest tax brackets would have to increase from 10% to 25%. The tax rate on incomes in the current 25% tax bracket would have to be increased to the 63% tax bracket. Yes, you heard that right. And the tax rate of the highest bracket would have to go from 35% and 37% today to as high as 88%. So for those of you that think that taxes are going to be and remain low for many, many years to come, I do have news for you. Just start looking around you, because at the end of the day, if you fall victim to the tax rates, is because you were not blindsided, because it's all around us. It's all around you. So you have a 7-year window right now in which to minimize your future tax liabilities because of all the benefits that you can get from the new higher standard deductions and certain benefits under the IRS tax code, including lower tax brackets. So as always, it's a pleasure speaking to all of you. And as I always say, if you have any questions at all, please feel free to reach out to me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com. And I would be more than happy to schedule a 30-minute conference call, a video conference call, at no cost or obligation to any of you that are listening to us on a regular basis, and I'll be more than happy to answer any questions that you may have. I'm actually working with many of you right now from all throughout the United States in areas of tax planning, in tax-free retirement preparation, and so forth. Lastly, I want to leave you, as I leave you every single week on each and every one of our podcasts, with a thought, which is something that I am a true believer in, because at the end of the day, my number one goal for each and every one of you is to kind of help you and your families change in the way that you see things. Because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a few minutes of your time today, and I'll talk to you soon. Take care. Bye-bye.